All right, we're going to go ahead and get started. My name is Jerry Sicalisi, and joining me today is my colleague Ryan Ransford. This is the first webcast of 2023, and it's on an exciting topic, one that we've been talking about for some time, which is now law. And this will be the first of many communications on this topic of Secure 2.0. As you can see, we have a very full agenda. We're going to be moving through this pretty quickly as we try to keep this webcast at 30 or so minutes. What we hope to give you is an overview of the Act, focus on some of the biggest changes and what you need to know now, what's mandatory, what's optional, how we're preparing, and most importantly, how we're going to be helping you, our clients. Just a few housekeeping items before we get started. Request all questions be submitted through the chat functionality. We're going to collect those questions and build out a Q&A with responses to some questions we've already answered from clients, and we'll be distributing that later this month. It goes without saying, if there's an immediate question, feel free to reach out to Ryan, myself, or your day-to-day contact at Sentinel, and we'll be sure to get you that answer. In addition, our ERISA consultant team is fairly close to finalizing a manual that will include the provisions of Secure 2.0, including a short description, as well as the effective dates, if it's mandatory, if it's optional, and we intend to get this distributed to all our clients and partners in the very near future. Lastly, this webcast is being recorded, and a copy of the recording should be available on our website before tomorrow. So looking back, it was almost 3 years to the day that the original Secure Act back in 2019, referred to as Secure 1.0, passed in a very similar fashion in the final days of December. And this retirement bill, Secure 2.0, was included in the federal government's Consolidated Appropriations Act, which is the federal government spending package for the fiscal year. And much of what was included were policies driven by a group of bipartisan policymakers over the last few years. And a lot of this includes unfinished business from Secure 1.0, some tweaks from 1.0, as well as some innovative provisions to enhance the American retirement system. As a result, Secure 2.0 is substantially larger, roughly 3 times as large than Secure 1.0, with almost 100 provisions. Secure 2.0 is estimated to cost over $40 billion when you look at the expense over the 10-year budget window. And as a result of how the legislation was passed, that expense needed to be offset by new revenues. And that really has opened the floodgates, particularly with Roth contributions. And you'll see a lot of Roth today as we move through this presentation. And it makes sense because Roth generates revenue for the federal government and largely offsets the expense of this bill. So anytime you have a large retirement reform package like this, there tends to be a theme. And with Secure 2.0, it's addressing a coverage issue, with close to 45% of Americans either not contributing to the retirement plan that they have access to, or those that just simply don't have access to a workplace retirement plan. We can pretty much throw each of those 92 provisions in Secure 2.0 into one of these buckets. Bucket number one, how do we incentivize more employers, particularly smaller employers, to implement and maintain a retirement plan? Bucket two, how do we get those employees into those newly created plans? Bucket three is, how do we create engagement for existing plans? Meaning, how do we get younger people in those plans to save earlier? How do we increase the contribution rates for those that are well into their career so that they're better prepared for retirement? And option four is, how do we stretch their savings in retirement? Again, this is the first conversation of many communications to come. We are still assessing the law, working through on mobilizing the work to operationalize a lot of these provisions. Fortunately, the government gave us a good runway. Most of these provisions are optional and most have an effective date beginning in 2024 and beyond. I will note our initial focus is going to be on those provisions that are mandatory. As for the optional provisions, we're going to take into several considerations, including effective dates, demand, guidance that may be needed by the DOL or IRS, in other factors in order to prioritize those provisions being operationalized. I will note with any legislation, there often is a lack of guidance, and that's no different here. We fully intend the IRS or the Department of Labor to step in and provide additional guidance, which ultimately may change the look and feel of what this looks like. Congress gave us a long runway to adopt these provisions through amendments. You can start using these provisions and you don't have to amend until the end of the year in 2025. And that's largely part of the reason why Congress gave some of the regulators, the DOL, the IRS, an opportunity to go in and provide that guidance. So with that said, I'm going to pass the next slide to my colleague, Ryan, who will begin a discussion around some of those high impact mandatory provisions.
Thanks, Jerry. So here we have some of the mandatory provisions. Jerry mentioned that we do have a kind of a longer runway for some of these effective dates. Part of what we'll be going through today are telling you what you can adopt now, and as well as what will be available in future years. Some of these mandatory adoptions have different effective dates. These are really the top 5 that we wanted to share with all of you. The first one being changes to catch-up contributions. This was a big one that we were hearing about for quite some time, so we'll dive into each of these in the next few slides. Second is the changes to required minimum distributions. And the third, accelerate long-term part-time employee requirements. So number 2 and number 3 were kind of add-ons or really built off of the Secure Act 1.0. So we'll dive into those. And then 4, the hard copy annual statement. And 5, the automatic enrollment for new plans, which was certainly a big one that we were hearing about for quite some time. So if we go to the next slide, we'll start to dive into each of these. So the first one, section 109, is catch-up contributions. So for folks that are reaching the age of 60, 61, 62, and 63, this would allow an increased catch-up contribution, which would be the greater of $10,000 or 50% more than the regular catch-up amount. This does go into effect in 2025. So obviously, as the IRS continues to potentially increase those limits each year, as they did in 2023, the catch-up went from $6,500 to $7,500. So as that amount goes up, there's going to be more of an opportunity for those folks between 60 and 63 to have an increased catch-up amount, which obviously was a big part of what we were hearing about for the last few months. Section 603, which is the all catch-up contributions to qualified retirement plans are subject to Roth tax treatment. So when Jerry talks about the expense of this bill and the additional revenues, and mentioned a lot of that is going to be, kind of borne through Roth contributions. One of the provisions is this all catch-up contributions. Before it could go to pre-tax or Roth. Now all of them are going to have to go to Roth, with the exception of employees that make under a certain amount. And here it's listed as $145,000. We're certain that will be indexed as this goes into effect in 2024. But that'll be a big change moving forward for all retirement plans. Section 107, required minimum distributions. This was actually an increase with the Secure Act 1.0 that passed back in 2019. That increased the required minimum age from 70 to 72, and now we're seeing additional increases, which really go into effect in 2023. It increases from 72 to 73. And then will continue to increase eventually to age 75 you can see over the course of 10 years. So that'll eventually go into effect in 2033. One of the big provisions as well with required minimum distributions is it actually decreased the excise tax for failing to take an RMD timely, which was normally 50% on that RMD amount that was due. That is being reduced down to 25%, so really half, which is a great thing. So that was a big change that we wanted to highlight as well.
Yeah, and when you look at the original Secure Act, there was a provision to improve coverage for part-time workers. And under the original Secure Act, part-time employees who worked at least 500 hours per year for at least 3 consecutive years are now required the opportunity to enroll into the plan and make elective deferrals. This is likely to become one of the more challenging provisions as far as administrating it. The clock has already started. It began in 2021 when we look at Secure 1.0, and it's looking at that 3-year clock in 21, 22, and 23. And now those part-time employees would need to come in on January 1st, 2024. This is very relevant to plans that have an employee base with part-time employees, particularly if your plan has a 1-year eligibility requirement, because historically you'd be able to keep out those part-timers because they didn't attain 1,000 hours. Well, now you'll have to bring them in, and these employees will also earn a credit for vesting for years of service if they have 500 hours of service. Secure 2.0 reduces the 3-year period to 2 years and disregards any service prior to January 1, 2021 for both eligibility and vesting. It also extends the rule to ERISA 403B plans. One of the things you'll start to see throughout this discussion, it almost feels like there's the intent of ERISA 403B plans to start to look and feel a little bit more like 401k plans. And this is just one of many examples in Secure 2.0 with the 403B plans that clock starts in 2025.
Yeah, and another one that Jerry and I were actually quite surprised on, Section 338, which is the requirement for an annual paper statement for defined contribution plans, unless the participant elects otherwise. So this would actually kind of, we were going a lot towards e-delivery with participant statements, and this kind of directs it back towards requiring to provide an annual paper statement to employees unless they, elect otherwise. And this would just be one statement per year. This goes into effect after December 31st of 2025. So certainly some time for, kind of the operations to catch up with exactly how that's going to be distributed. But for defined benefit plans, it requires a paper statement that must be provided once every 3 years. And again, unless a participant elects otherwise. So certainly a little surprising that it's going back to the paper statement route. We'll have to see exactly how those participants would elect and what it looks like from an operation standpoint. But obviously a lot more to come there, considering that it doesn't go into effect until 2026.
Yeah, this section here with automatic enrollment it's going to require 401k plans and ERISA 403b plans to automatically enroll their participants upon becoming eligible. And the initial automatic enrollment amount is at least 3%, but no more than 10%. And each year thereafter, it can increase by 1% until it reaches 10, but no more than 15. And while all current 401k and ERISA 403b plans are grandfathered, I believe this will have a profound impact on existing plans. It sort of sets a new benchmark for how employees are treated upon becoming eligible. And I also think you'll start to see some other innovative design features like re-enrolling participants. Automatic enrollment here, it's here to stay. One caveat to this is this doesn't go into effect for some time, but in the regs, it says if you start a plan after the act, so if you were to start a new plan for example, a 403B plan in 2023, come 25, you have to set up an automatic enrollment provision. So I think that's something we're going to need to see more guidance, but I think if you're setting up a plan now, you might as well set it up with automatic enrollment from the beginning, because you're going to need to change that come 2025. So interesting provision there. And I think, again, it's going to have a profound impact on existing plans. And we're really going to see the dial move with automatic enrollment. I mean, the studies are there. They show us it works, and it creates engagement, and participants are better equipped in retirement because of it. So we're going to move into some optional features and away from the mandatory. All of these begin after plan years, December 31st, 2023. So 24 would be the earliest. And, this is a great provision to start with your in-plan emergency savings account, particularly if you're an employer with lower paid employees who really are unable to save on their own. I'll note there was a Federal Reserve study back in 2019 that concluded half of Americans would struggle to cover an unexpected $400 expense, and 12% of them would not be able to cover it at all. So I think a provision like this would allow employers to add a short-term emergency savings account. This would only be allowed to be offered to non-highly compensated employees. I think the approach there is highly compensated employees should have the means to have their own emergency fund. But essentially, this would work with almost like the creation of a sidecar account that would be tied to someone's retirement account. The account would be capped at $2,500. It's required to be made up of all Roth contributions. The employer can establish a smaller amount if they don't want to go to that $2,500. An employer could also automatically enroll participants at a rate up to 3% into these sidecar accounts. And these sidecar accounts will run concurrently with someone's retirement account. Now, there can't be any employer contributions that go to these sidecars. This would only be employee Roth money. There's no early withdrawal penalties, and you don't have some of the requirements that you would have with Roth over 5 years before it came qualified. There are a lot of questions here. What happens if someone is non-highly and then they become a highly? And to a certain extent, there is some guidance that's already out there built into the law. Under that approach, they would just stop contributing to that sidecar, but would continue to be able to maintain it. I think there's going to be a lot of difficulty tracking highly compensated employees, and that will require either payroll systems being updated or record keeping systems, just to have a block in their systems to prevent HEs from setting up these sidecar accounts. Now, this does not allow for participants to save more. They're still capped at that annual limit, $22,500 plus the catch up for 2023. But this $2,500 can be part of it. And there are some rules around, fees that are associated with distributions of these. You have to allow the first 4 fee-free, and you have to allow for participants to be able to pull this money out at least on a monthly basis. So for those lower paid employees, this is a really good feature. The second piece is tied to employer matching contributions. And this is something that we've been working on for some time, knowing that this was going to be likely included in Secure 2.0. And this would allow for younger people that just don't have the discretionary income to make elective deferrals to the plan and pay their student loan debt payments. So this would essentially allow employers to give a match on student loan repayments. And there's a lot to unpack here, but it would probably look like this. It would be a true-up contribution at year end, right? The year has passed and Sentinel would calculate a true-up contribution, and we'd identify those that still had match on the table, capacity to get match. And we would communicate with them and likely say, hey, you've got this amount available in match. If you had a student loan, here's the process to go through to get a match from your employer. Now, again, this is an optional feature. All of these are optional. You don't have to add these, but this is a really unique feature that could help those younger folks that just can't afford to pay their student loans and defer at the same time. It just allows them to no longer miss out on that employer match if they choose to.
The third one down, withdrawals for certain emergency expenses. So this actually kind of builds on the first one there in the in-plan emergency savings account. I think an idea was in order to get more savings to retirement plans for all employees, they're going to have to allow, certain distributions so that people who are in the tough spot can go in and request a distribution. This allows for an emergency distribution up to $1,000 that is not subject to the 10% early withdrawal penalty. This is strictly for kind of the unforeseeable or immediate financial needs relating to personal or family emergency expenses. I think the employee would self-certify and they would be allowed one distribution a year up to $1,000. There's some additional information there about, if they pay back the distribution, they'd be able to do one a year. And if not, it's really one every 3 years. And this again would go into effect 2024. So just allowing, obviously we've gone through the pandemic in 2020 with COVID. This allows for kind of the additional emergency savings or kind of distributions that can be made through a retirement plan. And then the fourth one here, increased cash out thresholds. Obviously that provision has been in place for quite some time within retirement plans. Currently, it is up to $5,000. So this is for the terminated employees or former participants that still have a balance in the plan. Employers were able to move account balances under $5,000 to an IRA. This is increasing that amount up to $7,000.
Great. As far as what I can adopt now, there are provisions that were made available the day of the act. Again, some of these, there needs to be a process to operationalize that. And we've already started to work through that. We'll start with employees being able to self-certify hardship. So historically, when an employee had a hardship withdrawal, it was on the sponsor to make sure that that hardship correlated to the IRS reasons and certify that it met those hardship reasons. So now an employee will be able to self-certify. Obviously, we need to make some changes to our workflow as far as how hardship distributions are processed, and we're working through that now. I will say that there is some guidance that's already been requested, and that ties to what if an employer knows that the employee is lying? What happens if they're requesting a hardship every month because their car is breaking down? And I think what we will see is some guidance that the IRS and will provide to employers that will give them the ability to put the brakes on and say, no, we know that this is not a real hardship and not approve that distribution. As far as employer contributions to Roth, again, this is one of those features where the government's trying to generate more revenue, and it's going to allow employer contributions, whether it's a matching contribution or a safe harbor contribution or a non-elected profit sharing contribution, to come in as Roth. To a certain extent, it could be done indirectly today through a Roth conversion in plan, but this will allow it to happen a little bit easier. There's a lot of questions here. This is an area that we're going to need guidance, right? Is it a W-2 event? Is it a 1099 event? When is it designated as a Roth? When it comes to the record keeper? So this is one of those things we're not going to run to the races to get into operation. We're probably going to seek guidance. And I think the record keeping industry is aligned there with that provision. Diminished financial incentives permitted. So historically, you can never, employers could never incentivize employees other than offer a matching contribution. And this just simply allows for an incidental incentive. And the idea would be if someone is hired and they're approaching eligibility, you can now give them a reasonable gift card to maybe Starbucks or Amazon, and say, hey, we're going to give you this if you maintain the automatic enrollment, or we're going to give you this in the case where there is no automatic enrollment to enroll into the plan.
Yeah, the fourth one down, reduced notice obligation for unenrolled participants. This would actually allow employers the ability to no longer require to provide, really all of the typical required notices to employees once that participant has, upfront gotten the required information, and then thereafter they're not required to get that information any longer. The one piece of this provision that's interesting is, even though they're no longer required to be given all the typical plan notices, they are required to receive an annual notice that outlines the eligibility and also the benefits of the plan. So we kind of look at it as you're going from maybe a few different notices throughout the year down to one that is just strictly on when the person is eligible and the benefits of the plan. So this is something that certainly going to lessen the burden for employers, but it does create kind of an additional notice that they'll have to hand out to those unenrolled folks. The last one, penalty-free early withdrawals. So this is a section that our provision within the law that allows for kind of an exception to the 10% early withdrawal penalty for distributions for a terminally ill individual. That's effective now as well. So again, just allowing more accessibility to retirement funds in the case of emergency, and certainly that qualifies. The few here, the Savers Credit Match. So this was actually changed, and you'll see the effective date really isn't until after December 26th of 2026. So we certainly have some time. I think as we looked into this, there's certainly going to be some guidance provided over the next couple of years. There was actually I think this is section 103. Section 104 is really a program in which the IRS is going to help promote this Savers Credit Match. We think that'll obviously take place from now until this effective date, but certainly a lot to walk through. This would essentially change from a credit paid in cash as part of a tax refund to a federal matching contribution that must be deposited to an IRA or a retirement plan. This is an IRS amount or really a government amount that's provided to the employee. It's 50% up to $2,000. And there's phase outs that are on the lower side. So for example, for a single taxpayer, this Savers Credit Match phases out between $20,500 up to $35,500. And for a family or filing jointly, it's $41,000, and it phases out up to $71,000. So certainly a lot of time between now and this additional Savers Credit Match effective date. There's going to be a program that helps kind of communicate this out to employees as well. But we think there'll be a lot more guidance here in the next few years.
Yeah, one thing that's got me really excited about the Savers Credit, Ryan, is historically, in order to get it, you needed to have a tax liability, and more often than none, lower paid individuals don't have a tax liability. They're receiving a refund. As I understand it, this change also includes the fact that they no longer need a tax liability. So this could be really huge for employers with lower wage employees to just have more incentive to save for retirement.
Yeah. Thanks, Jerry. And so the second one too, I'm excited about. This was a kind of an add-on to Secure Act 1.0. This allows for an additional credit for small plan startup costs. This is effective in 2023. So this originally, the current law was, or prior to this, was 50% up to $5,000 credit for the first 3 years for employers that started a retirement plan for their employees. This was up to employers with 100 employees. This is going to increase that for employers under 50 employees. It's going to now be 100% up to $5,000 for each of the first 3 years. So essentially it's moving from 50% up to 5,000 to 100% up to 5,000, trying to incentivize employers to create these retirement plans for their employees and just allowing more accessibility for the employees to save for their retirement.
Yeah, and as far as the retirement lost and found, this is something exciting. The DOL has been tasked with the creation of a national database in the next 2 years that would allow an employee to search and try to locate their retirement savings. Oftentimes, employees move to different jobs and they don't take their money, they leave it with their former employer. And then 20 or 30 years go by and that employer has since been acquired or maybe went out of business. And now that employee is trying to track down those assets. And this will just make that process that much more easier. Conversely, the same struggles happen with employers who have terminated participants in their plan and they can't find them. This database will allow them the opportunity to search for those people and get those benefits paid or started, depending on the type of plan. So we've covered a lot here, and I want to make it really clear. This is the first communication of many. There is a lot to unpack here. We're still assessing the statute, and we are making it a priority to mobilize, to operationalize a lot of these features, particularly the mandatory taking the priority. We're likely going to be having another webinar in the future as we get closer to those operational steps. There are no amendments that are required now. You can technically start doing some of these things like the incentives with your employees who become eligible, and you don't need to amend the plan to the end of 2025, largely because there's zero guidance right now from the DOL and the IRS. And we fully expect to see guidance on a number of these provisions, some of which we've pointed out. I'm going to try to tackle just a few questions here, and then we'll wrap up. One of the questions are all these changes applicable to 403B plans or just 401ks? There are a lot of changes with 403B plans, assuming that they're subject to ERISA. Even beyond some of the things we highlighted today with automatic enrollment and hardship certification. But even when you look at hardships, starting next year, 403B plans that are subject to ERISA are now going to be allowed to offer other sources for hardships. That was a change that 401k plans saw as part of Secure 1.0, where they can tap into safe harbor and other employer contributions. Well, now 403B plans will have that same ability. And all of these optional features, for the most part, are available for ERISA 403B plans. So as I said earlier, we're starting to see ERISA 403B plans start to look a little bit more like 401k plans. Another question is there going to be an opt-out for the automatic enrollment as employees do not want to participate? Yes, there will always be the opportunity for a participant to opt out. Automatic enrollment really just forces the participant to make a decision. And as we know, and the studies show us, employees don't enroll, and it's because of inertia. And when they are automatically enrolled, most of them stay. So the studies show us it works. Last question I'll cover, can you adopt these optional provisions before the end of the year? All of those optionals that we talked about today are not available till 2024. So I know there's a lot of excitement. There's a lot of good things, particularly in underserved areas and lower wage employees. All of that will be available in 2024 as we work to operationalize a lot of these provisions. We're going to conclude our webinar just in the spirit of keeping to the time that we committed to. Again, there'll be a copy of the webcast on our website, and we'll build out a Q&A with the remaining questions. Thank you for your time today.
Thanks, everybody.